Hello everyone, and welcome to this edition of the NZX Virtual Investor event. My name's Oliver Logan. I'm from the Capital Markets Origination team here at NZX, and we'll be hosting today. I'll quickly just run through a little bit of housekeeping and then introduce our first speaker, Amy Castleton. So for those who aren't familiar with the format, it's a 10 to 15 minute presentation from each speaker, which will be followed by Q&A from the floor. So feel free to submit your questions through the chat function. This will be recorded and it will be available on YouTube following for anyone who's not able to attend or wants to rewatch. And just a disclaimer that nothing that is in the presentations will be considered financial advice. It's all just general information. Speakers we have today, first up is Amy, and we'll introduce her in a minute. We've then got Mark Malpass and Richard Smythe from Steel and Tube, and following them we've got Kevin Bowler and Mark Winter from My Food Bag. So good lineup today. But first up we have Amy. Amy Castleton is our in-house economist at NZX. So she's going to give us an economic update around where things are at. It's obviously been an interesting few months, so I'm sure she'll have a lot to talk about. Amy's background is in our kind of dairy team, dairy derivatives. So she's got a strong background in trade and has a good sort of international perspective through that dairy lens originally, but now with a wider focus. So Amy, I'll hand over to you, and you can let us know where the world's at.
Cool. Thanks, Oliver. Yeah, as Oliver said, I'm the in-house economist for NZX. I'm part of our capital markets development team and our data and insights team. So we do quite a bit of random stuff on providing insight to the marketplace. So I'll rock right into it. Most people know for New Zealand, what's happening internationally is really important. We're very exposed to the international environment due to our heavy reliance on trade. So what's happening globally, economically at the moment? A lot of the stuff we're seeing at the moment's being caused on the supply side of the economy. So we've had a heap of supply chain issues throughout the pandemic. That photo that I've got up on the screen there was back in April when Shanghai got locked down. So a big build-up of container ships that just weren't able to get through the port as effectively as they normally would due to the lockdown, due to not enough staff being available, those sorts of things. So shipping's taking longer. That means that parts and inputs and things that people need to make their goods and supply their services is taking a lot longer than it normally would have. And this has been an issue throughout the pandemic, so it's not new now. We've had a few years of this, but it's still a problem. And we've also got tight labour markets in a lot of places. So most places that manufacture a lot of goods for the rest of the world have a tight labour market, including New Zealand, and that makes it really hard to fix stuff and turn stuff around rapidly and fix the problems that are going on that supply side of the equation. On top of that, we've had the Russia-Ukraine conflict. So what's happening with gas prices is the most recent example of that, but we've had impacts on pricing for all sorts of commodities. Ukraine's a big supplier of a lot of commodities to the rest of the world. Russia's a big supplier of oil and gas. So that conflict's really kind of sent a lot of economic things, pricing, into a bit of a tailspin. Gas has gone up ridiculously over the last few weeks. This graph is already out of date despite being updated a week ago. So Russia's cut off their Nord Stream supply chain as of last Friday, which has sent prices even higher. Russia supplies around about 40% of Europe's gas, which is why this is such a big problem. So if Europe's not getting their gas, they're now facing an energy crisis, so that affects everyone. But for the pricing side of things, it means that manufacturing is going to become a lot harder in Europe. It's going to be a lot harder for European businesses to make their products if they don't have a source of power. What about China? So China's always a big concern for New Zealand. They're a big supplier of a lot of inputs to the rest of the world, but they're also a big buyer from us. So we've seen some not great economic data coming out of China recently. So while we've got a few growth figures there, bear in mind that for China, they're actually relatively low, and it's lower than expectations. So that's what matters to the market, even though things might be growing in China. If it's not meeting expectations, then that affects things as well. So industrial output, retail sales were not up as much in July as they were expected to be. Property investments down significantly. So property investments are a really big thing in China, and a really good indicator of what's going on in the rest of the economy. That was really down a lot. Unemployment's creeping up, particularly youth unemployment. So youth unemployment's at nearly 20%. That's significant as well. GDP growth actually fell last quarter as well. So that's not a great thing for China. They typically do grow their GDP in recent years. They're aiming for 5+% growth in GDP on an annual basis. So a whole quarter being down will throw that forecast. And as a result of all of this, their central banks lowered interest rates. So that's totally against what we're seeing everywhere else, including here. Most central banks are raising rates, but in order to address that growth problem, China's decided that they need to lower their rates. So that slowing economy is a concern for both sides of the market. So people that might be buying inputs from China, items such as steel, the steel and tube guys might be able to talk a bit better to that one, but so that's a concern on the supply side. On the demand side, China buys a lot of product from the rest of the world as well. So for New Zealand, for example, dairy, if consumers don't have the money to spend and aren't buying, then that's a wee bit of a problem for us as well. So what's actually happening here? So I'm sure everybody knows by now that inflation's a big problem here. Last quarter, the annual CPI figure reached 7.3%, so that's the highest that we've seen in more than 30 years. For us, it's a domestic problem as well as an international one. So what actually led that rise last quarter was housing and household utilities. So that's a domestic pricing problem, not an international one. Increasing prices for construction, so it costs more to build a house, and the cost of rentals has increased as well. On the international side, transport has gotten increasingly expensive, so that's influencing inflation as well. Petrol and diesel prices have gone up hugely. So in Q2, petrol prices had their largest increase since 1985. They were up 32% that quarter, and diesel was also up hugely, so up 74%. So prices are increasing right across the board, but those are a couple of key things driving our inflation problem. Sorry. So what's the Reserve Bank doing about that? The Reserve Bank has limited tools to try and address some of those supply issues, so they have to come at it from the demand side of the equation and try and cool demand down to match supply rather than trying to increase supply to match demand. So they do that by raising interest rates, so the central bank rate. Here we've now had 450 basis point rises and the OCR sitting at 3%. We haven't had it at that level since 2015, so it has been a while since we've been at that sort of level. Yeah, as I said, RBNZ is basically trying to cool down demand to try and match the supply. That's not quite happening yet, so they'll need to keep raising rates until they do actually see evidence of demand slowing down in order for inflation to come down. On the ground, for most people, they'll see that in something like mortgage rates or lending rates if you've got, for example, a personal loan. So mortgage rates have been creeping up since the end of last year, so that's about the time that the OCR started to raise. And the most recent data that RBNZ's got, July rates were averaging between 5.65% for the 1 year rate to 6.76% for the 5 year rate. So again, it's been a while since we've been at those sorts of levels for rates, so people are really feeling that cost of living increase. On the positive side, from an inflation perspective, maybe not if you're trying to sell a house, but house prices are falling. So in July, they were down 2.9% on a national basis. At this stage, that is really being driven by Auckland. So Auckland house prices were down 7.1%. Outside of Auckland, prices were pretty flat and were actually up 0.1% year on year for July. There is quite a bit of variability in that data, so it really depends on what region you're in as to what you're actually seeing in terms of house prices. We've also seen retail sales fall last quarter, so again, that's a positive for inflation. People are buying less products, so the volume of sales was down 2.3% quarter on quarter. And a lot of people are choosing not to buy some of those bigger goods. So the largest falls in those sales were electrical and electronic goods, motor vehicles, building and garden supplies, and then supermarket and grocery stores as well. Value was pretty flat quarter on quarter, so that shows that people are still spending the same amount of money, but choosing to buy a little bit less, so they're not increasing their costs too much. All of this is obviously affecting confidence as well. So confidence has been pretty poor. It has crept up a little bit in recent months. So we typically follow the confidence stuff in the ANZ surveys that they do. For consumers, households are still pretty concerned about the economic outlook. Living costs are high. They're pretty aware that interest rates are increasing. So things are going to keep getting tougher for the short term. The key indicator in that particular survey is whether it's a good time to buy a major household item. A net 17% of people in the last survey still believe it's a bad time to buy a household item. So people don't want to be spending huge chunks of money at the moment. Similarly for business, confidence has improved a little bit in the last couple of surveys. And businesses are mostly more confident about their activity outlook. So they are expecting activity to pick up. But they're also concerned about costs and inflation pressures. So that is translating into activity on the exchange. So the NZX 50, our key index, has been trending down for most of the year. We've had a bit of a tick up recently, but it has been variable in recent months. However, so that's translating into value traded as well. So over the first half of the year, value traded was down 23% on the first half of last year. Volume traded was down a little bit less, so down 12% over the first half of the year. So again, people have lowered their volume a little bit, but it's reflected more in the value figures than the volume figures. This isn't only happening in New Zealand. Most exchanges are seeing something similar happen. So what can we expect in the months ahead? Most forecasts are expecting that inflation peaked last quarter, but it is pretty likely that we'll still see inflation that's high for a little while yet. So the growth rate will slow down, but still be at that sort of 5 or 6% level for a while. RBNZ is not forecasting that it will fall back into their target range until 2024. As a result of that inflation growth rate, the OCR is going to need to keep being raised for a while yet as well. RBNZ at this stage is forecasting that it will peak at 4.1% in the middle of next year. So that's only up about 1% from where we are at the moment. It is possible that they will need to go higher than that before they're able to come down or stabilise for a little while. When we're targeting inflation, because we're seeing demand fall, growth will need to slow down. That's just a natural consequence of demand having to fall. It's possible that we'll see an actual recession, but most forecasts at this stage are looking at what's called a growth recession. So GDP growing at a very low rate and unemployment starting to rise. You might have heard that in terms of the US economy as well. They're looking at a very similar situation there, that they might see a growth recession while they're also trying to combat inflation. Also, as a natural consequence of growth needing to slow down, while the Reserve Bank tries to target that inflation, is pretty likely that unemployment will start to rise. Unemployment's still pretty low here in New Zealand, so it's still sitting at 3.2%, which for most measures is considered full capacity. So that's as many people unemployed as the economy can handle without turnover becoming a massive problem, and we are starting to see that. So we do need unemployment to start to rise a little bit, so things are a bit less tougher for businesses to hire people. That's me for today. We produce a monthly report, so if you're keen to hear a bit more from me, feel free to sign up at that link on the screen. Otherwise, happy to take any questions if we've got ones there.
Thanks, Amy. That's really good. We do have a few questions from the floor. So first one's, what do you expect might be some of the knock-on effects to the economy if inflation numbers were to fall significantly over the next, say, 12 months?
If inflation does happen to fall significantly over the next 12 months, we'd probably, I mean, realistically, I don't think that's going to happen, but if it did, in theory, demand matches supply, so we should be back in a pretty good position for the economy to keep ticking along.
And so maybe related to that, what would if that were to happen, how would the RBNZ potentially react to that? What would they do in terms of their rate cycle?
So if they do see inflation starting to come down significantly like that, I expect that they would probably stabilise rates for a little while. So say the next inflation figures out in a couple of months showed that suddenly inflation was back at 3% or something, I expect that they would hold the OCR at whatever level it is at that time.
Cool. And then a couple more. So one was just around, you've kind of already covered it, but your outlook for the next sort of 12 months, is there any particular themes that you're expecting?
I mean, inflation's the key theme for most places at the moment, and that will continue to be the thing for the next 12 months or so, I expect. I think we'll see a bit more around growth and GDP figures. Growth is likely to slow down for most economies, so not just New Zealand. Most places are facing the same problems, so they'll have the same sorts of consequences. I mean, those will be the key things. China's one to keep an eye on what's happening there, and not just the economic stuff as well. If they go further in their conflict with the States over Taiwan, that could also impact economics as well. So that's not just a political thing, that becomes an economic thing as well.
And maybe one last one, just around, you haven't touched on it in the presentation specifically, but just around currency, foreign exchange rates, and maybe could you comment potentially on the impact that the New Zealand US dollar exchange rate, maybe what that impact that's had on people's KiwiSaver balances, for example, or funds, sort of how that dynamic has played against markets falling? Yeah, so in terms of the New Zealand US rate, in general, we've seen a depreciating rate. So last I looked, it was sitting just over 60 cents to the dollar. So I mean, for things like KiwiSaver, it really depends on what kind of funds you're invested in. But I expect for most people, they'll probably see balances decreasing a bit due to that exchange rate. If you're exporting, however, a low exchange rate can be a good thing. So it makes our products a bit more affordable for some people. Yeah. Really depends. I think the outlook for that is that it will probably stay low, so sort of around that 60-61 cent type level for a while, particularly with the Russia situation. Great, thanks very much, Amy. We'll let you go. And next up, we've got Steel and Tube. So we've got Mark Malpass, who's CEO, and we've also got Richard Smythe, CFO and Company Secretary, joining us. So welcome, guys. Just a quick introduction on both of them and Steel and Tube. So Steel and Tube is sort of sources, processes and distributes steel products across the country. So involved in sort of heavy industry and a lot of the building sector. So Mark, CEO, and Mark's got significant experience since starting obviously as CEO in 2018 at Steel and Tube. Formerly was Chief Executive of Fletcher Building's Infrastructure Products, so strong background in the sector. Richard Smythe, CFO and Company Secretary, started last year in April, and formerly a PwC partner across Wellington, Auckland, and the US, and then also spent a bit of time at Sky City in a CFO type role there. So a lot of great experience, and probably quite a topical industry to be talking about as well. So I'll hand over to you both.
Great. Well, thank you, Oliver, and welcome to everyone joining us here online. With me today is as Oliver said, Richard Smythe, who's Steel & Tube's CFO. I'll start with an introduction on Steel & Tube, a bit about who we are, our products, the market structure, and our journey as a business over the last 5 years. Richard will then cover our performance and sustainability focus before coming back to me, and I'll talk about our growth strategy and also our outlook and take any questions. So Steel & Tube is one of the leading product providers of steel solutions, and we service customers through our national network and online platforms. We're a proud New Zealand company. We're in our 70th year of trading this year, and our goal is to be the best in the sector, the preferred choice for steel products and solutions, a rewarding place to work, and an attractive investment for our shareholders. We do this by investing in the things that matter. So our people, our customers, digital innovation, operational excellence, quality, health, and safety. We operate through two key divisions. So we have a distribution division and an infrastructure division. Distribution is where we bring products in or source products from preferred mills, and then we distribute them through our national network throughout the country. In the distribution division, we're basically a trader. So what that means is we aggregate products for our customers that don't have the scale to meet steel mill minimum order quantities. We have significant procurement scale to buy well, and we then sell on in smaller quantities while managing price and credit terms. So what matters in that distribution space is really good customer service, pricing disciplines, managing our mix towards high value products, and then basically keeping our operational and distribution costs as low as we possibly can. Now, our infrastructure division is where we really process products for sale. So we process them before we actually sell them. So this is typically on a contract or a project basis. It includes products like roofing steel, composite floor decks, large reinforcing assemblies that may be going into infrastructure projects like bridges and tunnels and wind farms, that type of application. So our core competitive advantage for Steel & Tube is our ability to cross-sell our extensive range of product offers to our customers. So you can see on this sort of market structure map on the slide here that we're New Zealand's, we have the most comprehensive range of steel products in New Zealand that includes services and solutions. So we operate in all key sectors across the sort of steel markets, and more than any of our competitors. And importantly, we are targeting sectors and products that both strengthen our core offer as well as move us up the value chain. So I'd like to talk a little bit about our journey. So Steel & Tube has really been transformed over the last 5 years. Prior to 2017, the company had made quite a few acquisitions, although its base business had been losing scale, particularly in that distribution business that I talked about. Now we've fully integrated those acquisitions, and they're all adding value to our group. We've also seen substantial positive outcomes from Project Strive that we drove in the first 3 years, and that was really driving benefits that are now dropping through. So for example, our national network, we've been able to rationalise that, but also maintain a national presence. So we've been able to reduce our lease costs by $2 to $3 million per annum. We've also had a very laser focus on delivering outstanding customer experience. We've locked in significant cost reductions, and we've also been able to invest in operational excellence and supply chain disciplines, which have obviously paid dividends through a difficult trading period of COVID and bringing products into the country. Yes, most importantly, we really have a great leading team across the company that are very passionate about what they do and very focused on delivering solutions and great customer experience. In the last couple of years, we've also moved to a growth focus. So that means that we've really concentrated on moving to high value segments and continued investing in those areas of the business that will create a diversified and resilient business. The 2022 financial year allowed us to demonstrate the value of that turnaround and also our focus on growth. We delivered a record financial performance and now have a very robust operating model in place to support our growth ambitions. We have a very clear focus on two pathways to continue to generate double-digit return for our shareholders. The first is continuing to strengthen our core business, and secondly, to grow by investing in high-value products, services, and sectors. We're very well positioned to deliver through the economic cycle. We've got the right expertise on board with both our board and management. We have an operating platform and a growth strategy that will create continued shareholder value. I'll now hand over to Richard before I provide an update on our strategic growth progress.
Sorry about that. We were very pleased to deliver record performance for the FY22 year, driven by a focus on customer service and value adds, operational performance, and disciplined supply chain management, which meant we had inventory available when our customers needed to support the growth across a range of sectors. Revenue increased 25% to almost $600 million. EBIT increasing 130% to $47.6 million, with EBITDA up 73% to $66.6 million, and our net profit almost doubling to $30.2 million. On the back of this strong performance, our board declared a final dividend of 7.5 cents per share, which will be 50% imputed, taking our full year dividends to 13 cents per share. Other key metrics also improved. In particular, funds employed, return on funds employed was 14.6%. As Mark has said, our company has been transformed over the last 5 years since we started Project Strive in 2018. You can see here the significant improvement in our financial performance to this year's record results, with the embedded value now being realised from Project Strive and our growth strategy that is underway. At 11.4%, Steel & Tube is a high dividend yield, with total shareholder returns of 19.1% in the FY22 year. We have a clear forward strategy, a strong operating platform, and the means to invest into growth. The turnaround and commencement of the growth strategy has been proven with this year's record results. Our long-term aim is to operate our business in a way that is financially rewarding to our shareholders and positive for our people, our customers, and our planet. We have 3 key focus areas: maximising steel's contribution into a sustainable and a low-emission society, supporting our people and customers, and delivering value to our shareholders. One new initiative that we're excited to support in 23 is a carbon credit offer in conjunction with HERA for our infrastructure customers. Now customers can opt to offset the embedded carbon in steel that they order, with Steel & Tube facilitating that through our partners. These credits will be passed directly through to the customer, with the cost being used to fund the planting and protection of native trees across New Zealand and the Pacific Islands. Steel & Tube does not make any money from this program. We are focused on continued improvement in key areas that matter to us. Our employee satisfaction net promoter score was 35 versus an industry average of 18. We were very pleased with this score. Also, importantly, our safety employee total recordable injury frequency rate improved to 1.13, well below industry averages of 5. Pleasingly, our people have rated their satisfaction score at 7.8 out of 10, a reflection of the supportive and strong culture at Steel & Tube. It is worth noting that early on in COVID, we recognised mental well-being was going to be important, and during the lockdowns we supported our people, not only financially, but also looking at their whole well-being. Every 6 weeks, we have continued to run webinars on a range of topics that affect our people both in the workplace and at home. These range from mental health, parenting, managing stress, financial advice, nutrition, and mindfulness. It is also important that our people and families were healthy and safe. We were the first to invest in COVID vaccine incentives. We pushed booster support, and we provided RAT tests for families. We have also invested in training and skills development for many of our workers who were stuck at home, to both keep them engaged and also allow them to upskill and progress their careers. Customer satisfaction also continues to increase, and our Net Promoter Score moved up to 40 compared to an industry average of 32. This is reflective of our ability to deliver products during what was a challenging year for our customers. Our greenhouse gas emissions reduced year on year, with a 21% reduction in emissions per $1 million of revenue. This is a result of multiple supply chain and operational initiatives. I will now hand back to Mark to give you an update on our strategic progress.
Thanks, Richard. Look, our goal is simple, to make life easy for our customers needing steel solutions and to be their preferred supplier of choice. We continue to build on initiatives under each of our 5 pathways, which again are focused on customers, our people, technology, service, and operational efficiency. With a strong business platform now embedded, we have moved our focus to growth. In particular, our efforts are concentrated on the 2 key areas to drive gross margin dollar per tonne improvements. These are firstly, continuing to strengthen our core foundation, and secondly, growing high value products, services, and sectors. The first area, building on our core, involves continued strengthening of our core business foundation, the foundation that is now in place. The focus is on building best-in-class customer experience, leveraging the breadth of scale to cross-sell to a wider range of products and services. It's also about leveraging industry-leading digital platform that we've put in place. Now in New Zealand, it is a very traditional analog business model across the steel distributors. What we've observed is trading and using digital steel trading is starting to emerge in the US and in Europe, which provides us with continued conviction to invest in our digital and IT offering and accelerate that shift for our customers to make life easier for them, also deliver efficiencies for our business and also New Zealand Bank. The second area of growth into high value products, services and sectors is all about focusing on expanding what we can offer to our customers. This includes adjacent materials and value-added services. We're very mindful the investment that our shareholders have made in our company. We don't believe in growth for growth's sake. Instead, we have taken a very disciplined approach to investment in new opportunities to ensure that we will deliver financial and strategic value. 2 examples of this growth strategy in action are our recent investment and expansion into plate processing capabilities and also the acquisition of Kiwi pipes and fittings. In plate processing, we've acquired new high-capacity equipment to expand our capability and offer. This was operational from June this year, on time and within budget. Plate processing is a high-value category with strong demand that provides attractive margins. It also builds on our existing offer that we already have in place, and it also has a very strong forward workload in place. On the 1st of August, we acquired Kiwi pipe and fittings, which is also symbolic of our strategy to selectively invest in high-value products and sectors. So Kiwi is a small business which specialises in fire and water reticulation products. It builds on our existing offer and provides us with scale and market share growth, as well as being immediately earnings accretive. Looking at the 2023 financial year that we've just started, we're expecting continued volatility in the global and local economy. Steel pricing is expected to remain elevated in the near term. Shorter term, steel demand is also anticipated to remain strong across most sectors. Medium to long term, demand will moderate in some sectors, for example, residential, where we will see some softening off the recent extraordinary high levels of demand that we've seen. We have a clear focus on continuing to strengthen our core and invest in high-value products, services, and sectors. The majority of our growth will be organic. We will also continue to consider small bolt-on acquisitions where they meet our criteria. The benefits of our strategic initiatives are expected to commence this financial year and will be fully reflected in the results of the 2024 financial year and onwards. Our goal is to continue to deliver sustainable double-digit return on funds employed for our shareholders. Thank you for listening, and I'll now hand over for questions.
Great, thanks Mark, and thanks Richard as well for that. A couple of questions. One, Mark, just on supply chain. Where is a lot of your sort of raw material sourced from, and how have you seen the sort of dynamics around that over, say, the last 18 to 24 months change through your supply chain?
Yeah, look, I mean, we would be sourcing somewhere between 40 and 50% of our products locally through New Zealand Steel and Pacific Steel. And then that balance of, at least half of our products are coming in from offshore. So we'll be buying from many parts of the world, mostly through, the Asia Pacific region, everywhere from China through Taiwan, Japan, other markets through the region. So the change in dynamic over the last 18 months has been, massive. We've seen, huge congestion in terms of supply chains, both in physical flows of product into the country, as well as port congestions in country and from source location. We have seen in the last, 3 to 6 months, some of that congestion easing up and some of the mills coming off allocations, which is pleasing. But we're still seeing some very high freight rates out there, and it will take some time before they normalise back, but for both bulk shipping, which is, still very high, and even containerised shipping.
Great. Yeah, thanks. And Richard, looking forward, are there any sort of sectors of the economy that you at Steel and Tube look towards as sort of leading indicators around what demand might be doing? Or there's probably the obvious ones in terms of construction, but are there any other things outside of that you guys, when you're looking forward and on the more on the demand side, consider?
So as Mark mentioned, residential is the area we think we're going to start to see some moderation. We track very closely all of the sectors that we perform in, that we operate in. So, but residential is the one that you'll start to see. We also track, as Amy said, interest rates and the like. So as those rise, we are very aware of the potential impact it can have elsewhere, and we watch those sort of indices quite closely.
Great, thanks. And one last one might be for both, or whoever suits best, in terms of, Mark, you mentioned acquisition opportunities going forward, small bolt-ons. Have you seen over the last 12 months, in terms of where the interest rate cycle's gone, the dynamics there change in terms of valuation expectations, or just the appetite out there in the market?
Yeah, look, I mean, I think it's a fairly active M&A market right across New Zealand, as many commentators have reported, in the recent months. For us, we're more a trade buyer, so we have a sort of a very clear window that we look at, in terms of opportunities through that. We've got quite clear criteria around the type of businesses that we're interested in. They're really in that higher value segments that we want to grow into. Our first pathway is always organic growth, and we are actually growing in quite a few products that we've invested in inventory and to grow. But where we can't either grow quick enough, or that we can see the market structure doesn't need another participant, we'll look at buying, as we did with Kiwi Pipe and Fittings. So, potentially the opportunities have opened up a little bit in some of those sectors. I think with probably working capital requirements for many businesses have been fairly stretched, as we've seen very high commodity pricing over recent periods, particularly post-COVID, but also with the unfortunate events with Russia, Ukraine, and some of the other items that Amy mentioned are kind of driving those factors. And so that's, of course, stretching the balance sheets of typically smaller businesses as well. And I think, you're seeing that across many parts of the economy. So we do see some quite, nice macro thematics around, the infrastructure markets, are underspent in New Zealand. And so there's quite a lot of activity to come there in future periods. We're also seeing, manufacturing, some of the factors that Amy mentioned around, the low dollar perversely is quite helpful for manufacturers. And I think as many have realised that in a COVID environment, actually local manufacturing sometimes makes more sense. And so we're seeing some growth. And of course, rural agricultural activity there, and commercial is still quite strong. So you're seeing some good opportunities in the market. And of course, for us, steel's it's a great circular economy product. It's very sustainable, and so it's quite a sweet spot, if you like, in terms of the economy at the moment for steel.
Great. Thank you very much, Mark and Richard. I'm sure everyone got a lot out of it, and so we'll hope to have you on again soon.
Thanks, Oliver.
Thank you.
Next up, we've got Kevin Bowler and Mark Winter joining us from My Food Bag. So Kevin's CEO at My Food Bag and join us now, and Mark's CFO. Most joining will be familiar with My Food Bag and what they do, so I'll leave it to you guys to introduce a little bit more around that. But just introductions around the speakers. So Kevin's previously been CEO at Fruka Beverages, Tourism New Zealand, and Yahoo Extra. So brings a wealth of experience to the My Food Bag team. Mark has previously been at Fonterra as Group Financial Controller, so is obviously also background in food and beverage, but also finance aspect to it. So without further ado, we'll hand over to Mark and Kevin.
Thanks, Oliver. I appreciate the introduction. My Food Bag's a very different business to Steel and Tube. We're just 9 years old, and you'll hear predominantly from me today, and with some support from Mark. So I'll just ask Mark to flick us forward. My Food Bag at a glance. It's a well-established business, and it's across its 9 years, a well-recognised brand. We have got a very strong database of New Zealand households who have purchased from us before, and a very strong knowledge base around what Kiwis want to eat, with something like 10,000 rated recipes in our database. We reach nearly all urban addresses with support from New Zealand Post, who have been working with us from the very beginning of the inception of the business, and continue to be a very strong partner for My Food Bag. What we have now is a very strong platform for growth. We're starting to innovate on that, and I'll talk a little bit about how some of that's playing out over the course of this presentation. Thought we'd start with some quick highlights from our year that ended at the 31st of March this year. Revenue was just under 200 million. EBITDA was 34.2 million, at a margin of 17.6%, and NPAT was 20 million. Average order value was $126, and very high or very positive news around our high value customer growth. Contribution margin was a strong 27%, and we were able to meet or exceed all of the dimensions of the business that were offered to the market prior to listing in our PFI. We paid a 7 cents per share fully imputed dividend, and in our most recent market announcement, the board indicated its expectation that an interim dividend will be paid in line with last year, this year. The business model has many similarities with food businesses, but some differences as well. The key thing is the weekly cycle. So the week for us typically commences on a Sunday evening with customer orders locking at midnight. Customer payment occurs overnight, and then starting with a clean sheet or a clean floor, we procure the food from our many suppliers, predominantly in New Zealand, on a Monday morning, and that food's delivered through Tuesday, Wednesday, and sometimes into Thursday when picking commences. We're picking in 3 locations, 2 in Auckland and 1 in Christchurch, and then we start distributing to customers on a Friday for delivery into customers' addresses on Saturday. The majority of customer deliveries are on Sunday, and then some are also the following Monday. And that is the nature of the cycle. What's so great about that is, of course, we are able to be paid in advance, and we're making to order. So we're not incurring any stock obsolescence risks, nor are we buying inventory that we don't need. So we've quite a scalable business from that point of view, and the negative working capital aspect makes it a very cash accretive business. In terms of our growth strategy, we've defined this into 3 general buckets. One of them is winning in meals, which is our heartland where we started the business, and we're already showing how one of the ways that we're thinking about that is by investing in ready-made meals. We're also looking to expand what we do, and we've introduced an assortment of products and food solutions under the banner of the My Food Bag Kitchen, which is continuing to grow and show real promise in terms of where the business might continue to expand towards. We're also looking and actively evaluating some new categories where we've got a very strong culture, but we're also taking the advantage of resetting that as people return to the office at the back end of the effects of the pandemic. So we've just done quite a big program around people and culture, and we're really excited to start sharing that with staff over the next few weeks. We've got a big focus on operations. Operations is a key area for us in terms of maturing of the business, bearing in mind we are only 9 years old. And I'll talk a little bit about the operations as we come forward. And of course, ESG is a really important part of the business from a measurement point of view and a strategy point of view and a decarbonisation perspective. What you'll see from this sort of business is a business that's all about reducing waste, both at our end, but also for consumers, and that they're only receiving the food that they've ordered and what they need for the week ahead. So in terms of winning in meals, what we've seen here is very strong performance across a portfolio of brands, which has proven very successful. We have an entry-level brand in Bargain Box, which of course has worked very well in these more difficult economic times. Our leadership in ready-made meals is going from strength to strength as we grow that breadth of offering, and also look to new channels to distribute it alongside our meal kits. The kitchen has already proven to be very successful in driving average order value, and we are continuing to expand the number of products we're offering in the kitchen, and I'll show that shortly. And the kitchen's also in giving us insights into what our customers are interested in buying, and not all of the products that we thought would be successful have been, and some that we weren't so confident in have actually done very, very well. And we continue to look at some relatively small M&A bolt-on opportunities. Talked a little bit about culture and capability already, but that's a big focus of the business this year. One of the other big areas is just strengthening our foundations, particularly around operations. We have a very manual operation at the moment, and I'll talk shortly about how we see that transforming into something with more technology, which will support both more innovation but also a higher quality product output. We're continuing to do a lot in the ESG area. One of the most recent things we've done is remove the plastic wrapped wool insulation with a cardboard solution, which from a temperature point of view performs just as well, but is easier for our customers to recycle at the curbside. So everything we can do about reducing packaging is high on our agenda. Of course, the caution there is to make sure that we're not jeopardizing food safety. This is an image of a new factory that we commissioned in April this year. This was built and leased back for us, and the transition to this plant was on time, on budget, and has continued to perform well above the previous facility that we had, and sets us up well for further growth in the South Island. It also allows us to buy more of the food locally, and not incur the risks of transport from the North Island, and also reduce food miles. Well, this is, among other things, a logistics business, but it's also a digital business. It's a native digital business, in that this is a very important interface between our customers and the businesses by web and app, and we've continued to drive and develop more personalised and customised features, allowing customers more flexibility in terms of the number of, or the types of meals that they buy and the number of meals that they buy. One recent very successful implementation was allowing customers to buy a gourmet upgrade for one meal during their week, rather than encouraging people to either buy all gourmet meals or all classic meals. So those sorts of flexibility features are something that we think customers are going to continue to want from us, and that we're looking at ways that we can deliver those more effectively. The kitchen, as I mentioned before, overall we've now exposed some 380 different products to customers, and at the moment, in any given week, we're somewhere around 150 different products across multiple categories, food and non-food. And we're getting a really good sense now of what customers are going to buy on a regular basis. And of course, this is very additive to the business, because there's no additional customer acquisition costs, and in most cases, no additional distribution costs. We're seeing 10 to 15% of our customers attaching something from the kitchen, with an average incremental order value north of $20 typically on average. And of course, we're continuing to improve the usability of our app and our web through sort of ongoing testing and learning. One of the big changes for us over the next 12 months will be the introduction of more technology into our picking and packing operation. This will have quality benefits, it'll have productivity benefits, but probably, and most importantly, what it will do is it will enable us to offer more customization and custom features and personalization features, so that customers can adjust their order every week without it overcomplicating the operational side of the business. In fact, the operational side of the business won't even really be affected as customers seek to personalize their order each week. So we're very excited about this, and we're in the delivery phase of what is about a $5 million investment in technology to be delivered in the North Island this summer and late summer in the South Island facilities. And that concludes the slides, and I'm very happy to take questions and look forward to those. Thank you.
Great, thanks, Kevin. We do have a couple of questions. So one's just around the sort of competitive environment that you're operating within, and sort of just speaking to how do you try to make customers as sticky as possible, and sort of stop them from jumping between yourself and a HelloFresh or another competitor.
Yeah, that's a terrific question. One of the things about the competitive environment I'd point out is that we've now had international competition in the market since 2018, so it's not a new thing for us. This is definitely our day jobs in terms of acquiring customers, reactivating customers, and retaining customers. So it's, and we think at the moment the opportunity is around making sure that the recipes are as good as possible, that our accuracy in operations is excellent, and that customers are delighted with every box they open. So making sure all that happens, and of course being competitive on price is also really important, particularly at the moment. And we heard Amy talk about inflation and the pressure that New Zealand households are under. We're very aware of that and very awake to it.
Great. And another one maybe just around the sort of the supermarket type offering as well. There's obviously been a lot of media coverage around the duopoly and what opportunities that might make for something maybe disruptive to come into that space. You probably see yourselves as being in there. Is it a case of kind of like you say, leveraging the existing network and distribution that you have and having it as sort of an add-on? But over time, do you see that as being a substantial part of the business?
I think it's an interesting space. There are likely to be some changes, some of which we think we may be able to take advantage of. So we're actively engaged in looking at how the industry may restructure and whether there's opportunities for us. I think the fundamentals are, and perhaps it's fair to say that the pandemic has accelerated this, is that more people are buying food online, whether they're buying it from a traditional grocery reseller or seller or from one of the meal kit providers. So that's really playing towards us. And then the question for us really is, how do we make the process of buying as frictionless as possible and the experience of the food as good as possible? And one of the big things that our customers keep feeding back to us is it's the lack of waste. So they're only getting the food that they've ordered, which is what they need for the week ahead of them, as opposed to buying a whole lot of things that they end up not consuming during the week.
Right. And one last one, just around sort of your geographic spread. Can you speak to, sort of your coverage across the country? Is there any places you're looking at going into, or have you got everything covered already? Or you mentioned obviously South Island, new distribution centre there. Sort of just around your geographic spread.
I think one of the slides mentioned that we've got about 86% coverage of New Zealand homes. And so the areas which we will have difficulty with our product to reach will be rural addresses. But we're constantly looking at city fringe growth, like whether it be on the edges of Auckland or other parts of New Zealand, to take advantage of people moving into new subdivisions and areas. So I think the geographical opportunity is marginal, but it continues to grow.
Great. That's it for now, but thank you very much for joining us, Mark and Kevin, and all the best going forward.
Thanks.
Thank you.
Cheers.
And that concludes the event for today. So thank you to all the presenters in particular, and also to the audience for joining us. As we mentioned at the start, the video has been recorded and it will be available online following for anyone who missed or would like to rewatch. And also, if there were any questions we were unable to get to, we'll send them out over an email, and we'll make sure we get answers for you. But in the meantime, thank you very much for joining. Our next event will be on the 20th of September, so in a couple of weeks, and we will see you then.